Morning everybody and welcome to the Aquila Markets macro update today on Friday the 23rd of April. And remember to view all of our terms and conditions at aquilamarkets.com before viewing any of our content. So let's get started. Few interesting concepts that we want to talk to you today. We've obviously been speaking repeatedly about this concept of Goldilocks, this idea of a pullback in rates, effectively a slight softening in the dollar, which creates this perfect environment for equities because at the end of the day, it creates this looser financial conditions in dollars, and that means that equities can really rally to the upside. And of course, the other thing as well is that equities feed into that financial conditions calculation too. So you have this reflexive nature to that. So I think that's one of the things that's been very interesting to us, but that has clearly paused. And we just have to look at the dashboard here and just look at the performance over the last week. The S&P is down a little bit. Look at the performance here across global indices. It's a real mixed bag. China's made a bit of a comeback, but notice weakness in the Nasdaq and in the Nikkei. And the DAX, which has been one of those big leaders that we've really been following, up a tiny amount. So I think that's pretty interesting. FX, if we look over the past week, is a bit of a mess, right? Dolly yen is a little bit lower. That makes sense because we've seen this pullback in US yields. The Kiwi is up a little bit, but not a lot. Key story clearly is Bitcoin. And we're going to talk about Bitcoin in a minute. But one of the things we just want to start with is to talk about just this idea that we've noticed over the past week of central bank policy starting to shift in certain countries. And the one that we really want to talk about, of course, is the Bank of Canada. We mentioned this going into Wednesday, whether they were going to taper or not. They have an issue because they're buying so many bonds. There's literally just not enough bonds in the bond market really to service themselves and all of the requirements that pension funds and life companies and various other people have to create fixed income cash flows to fund liabilities. So there is an issue there. They've tapered from 4 billion a week to 3 billion a week, okay. But it's interesting, there is an underlying hawkish tone. And so next week we come to the FOMC and Chair Powell is going to get pushed for a comment about this idea of the transitory inflation, given the fact that the numbers are coming through so very strong. Remember what FOMC has told us. They have told us they're going to focus solely on inflation. They're not going to look at any other data. They're only going to focus on that. Switch to the other side, and the Biden administration is continuing to focus on just printing money and throwing it into all sorts of different plans and packages. This focus of overstimulation, the fact that there are already too many dollars in the system right now, is just continuing. And so this push-pull between flows of dollars and inefficiency that's starting to build in markets to get those dollars allocated really becomes a big deal. For markets, they're just hunting the winners. That's what this market has done. It's been doing it now for months. It just finds the winners and hunts them down. And this is one of the things that's making this market so tactical. But underneath it, there are really, really big structural themes that we still are going on, that we still believe are really playing out. So let's come and look at the sector dashboard. Let's just look at the performance of sectors over the past week. It's a mess, right? There's really very little rhyme or reason to a lot of this. Oil and gas is lower, but energy have managed to hold in. We've seen weakness in metals and mining, weakness in semis at a time when there's a massive semi shortage. And if you just look here, there's very little between the equal weight and the market weight ETFs. There really just is this sense of waning momentum. Remember, this is at a time when inflows into equities, developed market equities, are off the charts at levels we have never seen before. And we have seen this, we believe, this rotation out from buying, core buying, which has caused this, fastest horses type of move that we've seen in certain sort of fashionable meme stocks, to just passive retail core buying. So as we mentioned earlier, this relationship between the financial conditions and the index performance is really important. And so we look at rates. We're going to look at rates in a second and we say, what is the reason for rates to basically continue to go lower from here? And we're just not sure what that is. We know the issuance is coming. We know the data is going to be pretty strong. We know that there's money going to be chucked out of helicopters in the US and other places. So that keeps us really on alert for looking for when we're going to see this turn in rates. Remember, we pointed this out on Tuesday, May is traditionally a weak month for equities and April traditionally has the best returns. A long-held theme that we've had here at Aquila is this idea of loss-making stocks. And, if we look back to the global financial crisis, the performance of stocks that make no money has outperformed stocks that make money. And a lot of that is obviously due to big cap tech. But this has really accelerated in the past year. And just look at this chart. I think it's a great chart. This is developed market cap. Okay, the percentage of loss-making companies, 17,000 companies in this. The red line here, you can see that the red line in each of the last 3 years is at records we've not seen since well above the 99-2000 zone here. So we really do recognize, and then in the last year, obviously, we're back up at these levels that we saw in 2001. companies are not making money, and so we keep having this big focus on earnings, but the concept of valuation has been forgotten because people just focus on stories. It's one of the issues with Bitcoin. We think, how do you value something that has no value, right? It's only what somebody's willing to pay you for it. And I think that's what's really interesting. We've had this long-term view that the pernicious effects of printing money just destroys real incentives, and it completely penalizes labor over capital, and one of the key reasons why we've had the income inequality we've had. Right, so what now? We think Goldilocks is pausing. One of the things that's been really interesting in the narrative that we've had, a conversation with many people, is why are rates going down at a time when the data is so strong and inflation seems to be coming down the pipe? And one of the reasons for that, we think, is that if you're a pension fund and you have a balance of equities versus bonds, by definition, the pace of the rally up in equities means that you need to be rebalancing. And to rebalance, you will naturally be a seller of equities and a buyer of bonds. Now, we've got huge amounts of retail flows still coming into equities. The new inflows, the new money coming in, we see that all the time. But the people that are selling is the old money, the people who've been long stocks for a very long period of time and who are managing a lot of the pension liabilities. So it makes complete sense for them to book their profits in equities and to buy bonds. And we think that's what's happening. We think that's why the Japanese lifers have been so active in buying fixed income, and that's why pension fund purchasing has been so strong. It's to do with actual cash flow management within pensions and actually has nothing to do with macro. But what it is doing is creating this situation where people are trying to fit narratives to price action around these things. And we really don't think that is sustainable. And so we're firmly of the view that we're looking for places now for rates to start ticking up again. And here's one of the reasons why. This is a chart I've shown before, and I really wanted to show it today on our Friday macro update. This is 3 lines on here. The green line here is US 10-year yields, okay? The purple line here is US inflation break-evens. That's inflation expectation. What do we expect inflation to be over the next 10 years? Now at 2.33%, that is above the Fed's inflation target of 2% on a PCE basis. So this tells us that the market's saying, you know what? Fed's going to do this. We're going to have more than 2% inflation on average over the next 10 years. But what is happening here, if we notice, is this concept of real yields. And real yields, as we keep saying, is really just the difference between the yield we get on a nominal bond relative to inflation. In other words, how much money do I get back after inflation over that 10-year period? If it's negative, that means that the value of your money in real terms, inflation adjusted, is going down over that period of time. So negative real yields are really, really unusual, right? And we can see this really amazingly here on this chart. We had negative real yields here back in 2011, 2012 when the global economy was still trying to struggle through the effects of the GFC. We broke up, look, and notice how it stayed above zero for a very long period of time. This actually was the effect 2017, 2018 of the Trump tax cut. Then the Fed started to tighten policy by tapering the balance sheet, hiking. And notice how real yields have just collapsed straight down and are very negative. This is not sustainable. People are not going to invest for the long term in the knowledge that their money goes down in value in real terms. Now here's a question. How do we get this to go back up to, let's say, up to zero? Well, if inflation break-evens stay the same, and we know that basically this is a simple sum, then it tells us that this number must go up to inflation break-evens. If this is zero, nominal rates must be the same as break-even rates. And that's one of the core reasons why we believe that what we're seeing in rates right now is transitory. Nick that word from the Fed. And we believe that yields are going to continue to go higher. So here is the 30-year. We can see the big breakup, look, obviously, that we saw back. You know, the beginning of what we felt was the real big move up here that started in August. This was the reflation trade that obviously here at Aquila we played. Acceleration, overdone. You can see that from the RSIs, RSI divergence, classic, and then this consolidation period. We've been watching this 220 to 223 zone as a potential support zone in the 30-year, right? Could we break lower down here into this 213, 210 zone? Maybe. But actually, we're going to look for any further sell-off in rates as an opportunity to effectively get short bonds and basically want to play rates to the upside. You know, and we also believe that if this starts to happen now, given the fact of the changes in tones in global central banks, we are going to see a synchronous move higher in global rates too. In other words, gilt yields will go up, bond yields will go up, and rates around the world will gradually go up. And this will have a negative effect for equities. Last 2 quick charts I want to get to. Bitcoin, more than a pause? Okay. Let's have a look here at this. Now, this is a chart with a Heikin Ashi chart, which creates a much more smooth type of trend play. What I've put on here as well, I've done it on a logarithmic scale. Logarithmic scale is much easier to see when we have these huge moves up because we get a much smoother path. One of the things I want to point out here is notice how on the log scale we started to see waning momentum on this rally up here. Notice the RSI divergence. We've been pointing this out forever. This doesn't look great. This looks like a chart that wants to go lower to us. Now, the Coinbase IPO was a potential catalyst for this, we think. At the end of the day, Coinbase was actually dragging money that would have gone into crypto, but goes actually into the Coinbase IPO. And the Coinbase market cap, as you know, was basically equivalent to bigger than ICE and many of the other exchanges. So, next question, what's the value of Bitcoin? We have absolutely no idea. This fits with our story of people buying things for stories, but without actually really having any concept of valuing it. So we think this can go down. We think this does affect risk sentiment quite significantly. And the last one, Dolly Yen. Dolly Yen has been one of our favorite trades for the last 6 months. The correlation with rates has been absolutely brilliant. We note that it got ahead of itself. That's why we restructured our upside Dolly Yen play and book profit up at 111. We've come down. Really want to point this out. The correlation with US rates is very strong. It remains a core long for us, and we hold it on the radar screen. 2, 38.2% retracement comes in at 107.75 of the entire high to low move. We are holding it, sitting on it right now. Plus, we have the trendline support that's coming in here basically at the same level. This has been a favored FX pair for us to the upside. It clearly remains so. We have a trade on that, we have the call spreads on as a placeholder. We're going to look to restructure those. We still really like this play, but we're in no rush. This could be very messy over the next few days. A lot of cross currents coming through, but we firmly believe as we move forward, we're going to see rates starting to resume their upward path. That's it from us for today. Have a great weekend, everybody, and good luck in those markets. Take care.